private payroll growth, it slowed in May to a 4-month low, providing yet another sign of weakness in the labor market. Here to discuss what the latest readings mean for the broader market and your portfolio, we're joined by Glen Smith, Chief Investment Officer at GDS Wealth Management. And thank you for joining us here today. What do you think about these economic reports we're getting? ADP, a little bit out of consensus today. Everybody looking ahead to that big payrolls report on Friday.
I think the market's trying to digest all this information. The payroll numbers Friday, we think they're going to be in line with the last few months. Probably expecting about 200,000, 200,000 number, maybe 195,000. That, along with next Wednesday's CPI numbers, is going to give the Fed a couple things to digest in terms of what they're going to do with rate cuts going forward. I think the market is softening a bit as evidenced by the 10-year Treasury coming down. So I think there's going to be some opportunities here going forward in terms of volatility, and there's some signs of a little bit of a slowdown. That being said, unemployment numbers have been almost 27 months now, sub 4%, which is the longest streak we've had since the 1960s. So on a positive note, the economy rear looking has done well. Just forward looking, I think it could be a little bit of a different picture.
Yeah, and I'm curious, you guys have about $1 billion under management. What are you hearing from your clients about whether they feel like the economy is slowing or what their concerns are around the market?
Main concern we're hearing is regarding inflation. While it has come down from nearly 9%, trending to that 2% number the Fed wants, it's still higher than people would like. And the best opportunity to beat inflation when it comes to investing is going to be with equities. So most of our clients have, I would say, 60 to 90% of their portfolio in equities, knowing that it gives them the best opportunity to beat that inflation number. It's important on the fixed income side of the portfolio to remember, if you believe that interest rates are going to come down some in the next year or two, you want to look at extending your duration on the bond part of the portfolio to give you a little opportunity for a little bit extra yield.
I'm wondering what you like in terms of sectors here. Tech is outperforming today, as it has the entire year, but we've seen other sectors rise and fall in various fits and starts. Financials have reared their head. We've also seen some of the cyclicals pick up, and just wondering where on the spectrum you fall when it comes to some of these large cap sectors.
Well, tech's done amazing. I think a lot of the easy money's been made at this point. The two sectors that we find most attractive are going to be financials and energy. Financials, we love JPMorgan, best of breed bank in our opinion. While it's had a rough couple years with investment banking, we think that's going to start turning around. In terms of if interest rates stay elevated, it has a bit of a hedge. Net interest margin should do amazing with JPMorgan, and if rates do come down, lending should pick up. And you can invest in the JPMorgan at 11 times earnings, which is very attractive when you compare it to a magnificent 7, if you will. In terms of energy, we love Halliburton. It also can be invested in at 11 times earning, one of the largest oil service providers on the globe. And it's doing very well financially, even though oil is only at about $70 a barrel, which is a sweet spot. And we think it's a bit of a hedge geopolitically. If things start to kick up in the Mideast again and oil goes up, Halliburton will do that much better at $80, $90 a barrel.
Hey, Glenn, I'm curious here about Halliburton in particular, because the financials might look good, but the stock price doesn't really. We've seen it actually underperform the rest of energy. So I'm curious why you want to get levered to oil through a services provider like Halliburton versus a pure sort of E&P play.
We think the little bit of a dip it's had is actually an opportunity for our clients, not a catastrophe. If you're looking for a short-term play, it's anybody guesses. Long-term, we think it's still priced very attractively, and the recent dip could work in our favor. Dollar cost averaging at these levels with a stock like a Halliburton.
What's on your horizon? What are you looking forward to in terms of a potential catalyst, or what are you concerned about in terms of a potential headwind?
In terms of a headwind, it's going to be this inflation. It's going to be interesting as the Fed digests the numbers coming out. We no longer think there's going to be a rate cut in June or July. At this point, we're thinking there's going to be a rate cut in September. And what we're hoping for is just not to have sticky inflation or that the Fed cuts rates too soon. And we have a situation like the 1960s where Arthur Burns cut rates too soon and we had persistent inflation for many years to come. So our main concern right now is inflation and how do we fight that in our portfolios.
So I want to circle back on that front to the allocation to stocks, right? As you mentioned, 70 to 90%. That seems pretty high, Glenn. So that's interesting. Like over history of investing for clients, how often have you been at 70 to 90% in stocks?
It depends on every client's going to be a little bit different. Most of the clients that we work with, they're pulling out 3 to 4% of their portfolio. And when interest rates are at their place at where they are now, we're a little bit more heavy fixed income today than we've probably been in over the last 6-7 years, because you can get an attractive corporate yield or a treasury yield where you couldn't 2 years ago, say. So right now we're a little bit more on the fixed income heavy side than we have been in recent past. But we think over a 10-year period, to give you the best opportunity to beat inflation, it's going to be equities, where historically they've done 10% versus a fixed income where you're going to look at 4 to 5%.
Glenn, real quick, we got about half a minute. Anything we missed here today that you want to tell investors?
I would just say this is a great time to look at your portfolio, make sure you're diversified. A lot of allocations and kind of gotten out of whack with Magnificent Seven, everything going on. Make sure you're not over concentrated in any one sector or stock that might be a little bit speculative at this point.
Glenn, thanks a lot. Appreciate it.
Thank you.